Investing is a crucial aspect of personal finance. It allows individuals to grow their wealth over time and achieve their financial goals. Starting early and investing consistently can make a substantial difference in the long run. By understanding the fundamentals of investing, individuals can make informed decisions and work towards securing their financial future. Before diving into complex strategies, it's essential to grasp fundamental concepts like asset classes, risk, and diversification. Investment horizon refers to the time you plan to hold investments. Risk tolerance reflects your comfort level with investment fluctuations. Diversification spreads investments across different assets to mitigate risk. Aligning investment choices with goals and risk tolerance is key to a sound strategy. Risk is an inherent element in investing, referring to the uncertainty of future returns. Higher potential returns usually come with higher risks. Market risk affects the overall market, while interest rate risk impacts fixed income securities. Inflation risk erodes purchasing power, and credit risk involves borrower defaults. Understanding these risks helps investors make educated decisions. The relationship between risk and return is fundamental in finance. Investors expect higher returns for taking on more risk. Government bonds are less risky than stocks, hence offer lower returns. Stocks carry higher risk but offer higher potential returns. Assessing risk tolerance and investment goals helps in choosing the right investments. Investing involves various risks, both systematic and unsystematic. Systematic risk affects the entire market and can't be avoided through diversification. Unsystematic risk is specific to a company or industry and can be mitigated through diversification. Examples include management changes, product recalls, and regulatory impacts. Diversifying portfolios helps reduce the impact of unsystematic risk. Return on investment (ROI) quantifies the profitability of an investment. It's calculated by dividing net profit by the initial investment cost. For example, a $1,000 investment sold for $1,200 yields a 20% ROI. ROI helps assess investment effectiveness and compare different investments. Tracking ROI provides insights into wealth growth over time. Holding period return, HPR, measures total return over a specific period. It includes income generated, like dividends or interest. HPR is calculated by adding income to the difference between ending and beginning values, divided by the initial value. For example, a stock bought for $50, sold for $60 with $2 dividends, yields a 24% HPR. HPR provides a comprehensive view of investment performance. Annualized returns convert returns over any period into an equivalent annual rate. The geometric mean or compound annual growth rate, CAGR, accounts for compounding. It provides a more accurate representation of average annual growth. For example, an investment with varying yearly returns has a geometric mean that reflects true growth. Understanding these concepts helps compare investments with different holding periods. Systematic risk or market risk affects the entire market. Economic fluctuations, geopolitical events, and interest rate changes drive this risk. For instance, recessions and political instability can impact stock prices. Interest rate changes affect borrowing costs and economic growth. Understanding systematic risk is crucial for informed investing. Unsystematic risk is specific to a company or industry. Business risk includes operational challenges and competition. Financial risk relates to a company's debt and liquidity. Regulatory risk involves changes in laws affecting specific industries. Diversification helps mitigate unsystematic risk. Section 3. Managing systematic and unsystematic risk. Understanding the distinction between systematic and unsystematic risk is crucial for investors. Systematic risk can be mitigated through asset allocation and diversification. Unsystematic risk can be reduced by holding a diverse portfolio. Diversification involves spreading investments across asset classes, industries, and regions. Losses in one investment can be offset by gains in others, reducing volatility. A portfolio of only technology stocks is risky if the sector declines. Diversify across stocks, bonds, real estate, and commodities. Stocks often outperform during growth, while bonds hedge during downturns. Adjust asset allocation based on risk tolerance and investment timeframe. The power of diversification. Diversification is a cornerstone principle for managing risk and enhancing returns. It involves spreading investments across various asset classes, industries, and regions. This reduces the impact of any single investment's poor performance. The concept of correlation measures how different assets move in relation to each other. Assets with low or negative correlations can offset losses, reducing portfolio volatility. Including bonds, real estate, or commodities, can mitigate sector-specific declines. Section 2. Beta and correlation, measuring risk relationships. To construct a diversified portfolio, investors need tools to assess risk relationships between assets. Beta and correlation are key concepts in portfolio theory. Understanding these measures helps investors make informed decisions about asset combinations. Beta measures an asset's volatility relative to the market, like the S&P 500. A beta of 1 indicates market-level volatility. Above 1 means higher volatility, below 1 means lower. Correlation measures the statistical relationship between two assets' returns. A correlation of +1 means perfect positive correlation. -1 means perfect negative correlation. Investors seek assets with low or negative correlations for diversification. Combining stocks and bonds can be beneficial due to their low or negative correlation. Section 3. Constructing a diversified portfolio. Building a well-diversified portfolio is an essential aspect of successful investing, helping to manage risk and potentially enhance returns. However, diversification is not simply about randomly selecting a variety of assets. It requires a thoughtful approach that considers factors like risk tolerance, investment goals, and time horizon. The first step in constructing a diversified portfolio is determining your investment goals and risk tolerance. Are you investing for retirement, a down payment on a house, or your child's education? What level of risk are you comfortable taking on? These factors will significantly influence your asset allocation, which refers to the proportion of your portfolio allocated to different asset classes. Once you've determined your risk tolerance and investment goals, you can begin selecting specific investments. A common approach is to start with a core portfolio of broadly diversified investments, such as index funds or exchange-traded funds, often referred to as ETFs, that track major market indices. These funds provide instant diversification across hundreds or even thousands of stocks or bonds, making them a cost-effective way to build a solid foundation for your portfolio. Beyond the core portfolio, investors can consider adding satellite holdings, which are more specialized, or tactical investments that align with their specific investment goals or risk appetite. These might include individual stocks, sector-specific funds, or alternative investments like real estate or commodities. However, it's crucial to remember that adding more investments doesn't always equate to better diversification. Over-diversification or holding too many investments can dilute potential returns and make it challenging to track and manage the portfolio effectively. When comparing investment alternatives, the age-old adage, "there is no free lunch," holds true. Higher potential returns typically come hand in hand with higher risk. This fundamental principle, known as the risk-return trade-off, underpins investment decision-making. Investors must weigh their risk tolerance against desired returns. Conservative investors might lean towards lower volatility investments. Bonds, particularly government bonds, offer regular interest payments and stability. Aggressive investors might gravitate towards higher growth potential, but also higher volatility. Stocks, representing ownership in companies, embody this characteristic. Between these extremes lies a spectrum of investment options with varying levels of risk and return. Navigating the vast landscape of investment options requires a solid understanding of key metrics that allow for meaningful comparisons. These metrics provide insights into an investment's potential risks and rewards, helping investors make informed decisions aligned with their financial objectives. One crucial metric is standard deviation, a statistical measure of an investment's volatility. A higher standard deviation indicates greater price fluctuations, implying higher risk. Investors seeking stability and predictability might prefer investments with lower standard deviations, even if it means potentially sacrificing some upside potential. Another essential metric is the Sharpe ratio, named after Nobel laureate William Sharpe. This ratio measures risk-adjusted return, indicating how much return an investment generates for each unit of risk taken. It calculates the difference between an investment's return and the risk-free rate of return, typically represented by government bonds, and then divides it by the investment's standard deviation. A higher Sharpe ratio suggests a better risk-adjusted return, making it a valuable tool for comparing investments with different risk profiles. Investors aiming to maximize returns for a given level of risk would seek investments with higher Sharpe ratios. Furthermore, understanding an investment's expense ratio is crucial. This ratio represents the annual percentage of assets deducted to cover management fees and other operating expenses. Actively managed mutual funds, where portfolio managers actively buy and sell securities to outperform the market, typically have higher expense ratios than passively managed index funds or ETFs that track a specific market index. Investors should carefully consider expense ratios as they directly impact net returns. Throughout this comprehensive exploration of investment fundamentals, we've delved into the core principles that underpin successful investing. We began by establishing the importance of investing as a means to grow wealth, achieve financial goals, and combat the erosive effects of inflation. We then delved into the crucial concepts of risk and return, emphasizing the inseparable link between them. Higher potential returns often come with higher risk, and investors must carefully assess their risk tolerance and align their investment choices accordingly. Understanding different types of risk, both systematic and unsystematic, is essential for developing effective risk management strategies. We explored various methods of measuring investment returns, from basic return on investment, ROI, and holding period return, HPR, to annualized returns and the geometric mean, which accounts for the power of compounding. These metrics provide investors with the tools to evaluate investment performance, compare different investment options, and track their progress toward their financial goals. Diversification emerged as a cornerstone principle for managing risk. By spreading investments across different asset classes, industries, and geographical regions, investors can potentially reduce the impact of any single investment's poor performance on their overall portfolio. Understanding beta and correlation, measures of risk relationships between assets, is crucial for constructing a truly diversified portfolio. As we conclude this introductory journey into the world of investing, it's essential to emphasize that investing is not a one-time event, but rather a continuous process of learning, adapting, and making informed decisions. The financial landscape is constantly evolving, influenced by a myriad of factors, including economic conditions, geopolitical events, and technological advancements. Successful investors remain vigilant, staying informed about market trends, economic indicators, and changes in the regulatory environment. They regularly review their investment portfolios, rebalancing as needed to ensure their asset allocation remains aligned with their risk tolerance and investment goals. Furthermore, they understand the importance of seeking professional guidance when needed. Financial advisors can provide valuable insights, personalized advice, and help investors navigate complex financial decisions. Whether you're a novice investor just starting or an experienced investor seeking to refine your strategies, remember that investing is a marathon, not a sprint. By embracing a long-term perspective, staying disciplined, and continuously expanding your knowledge, you can position yourself for financial success. As you embark on your own investment journey, armed with the fundamental principles and tools discussed throughout this course, remember that the key to successful investing lies not in predicting the unpredictable, but in making informed decisions, managing risk effectively, and remaining committed to your long-term financial goals.